Is the tech sell-off over? I'm Michael Smith, and welcome to the Lowdown. Hey everybody, I'm Michael Smith, and welcome to Lowdown. Today, joining me is Kevin Lennox. Kevin, welcome back to the show.
Good to be here.
Well, good. Well, you know what, Kevin? A lot has happened since the last show, and we're going to cover some things today. But I thought, why don't we start off with earnings and what's been happening on that front? So, where are your thoughts on earnings, and what are you seeing right now?
Coming into earnings season, expectations were for profit growth of 8.9% on the S&P 500. We're about 41%, or about 41% of the companies have reported earnings so far. We're on pace for 9.8% earnings.
Okay.
Biggest pickup have been in big tech and financials. And profit margins, which really speak to the top 100 companies in particular, at 12.1% versus 11.6% for the same quarter a year ago. So the earnings front, even revenues are up 5%. So we're off to a good start. We had concerns about could big tech keep carrying the load, and then the overall strength of the consumer and businesses, and we're happy so far.
Well, I do want to point out and pat you on the back. I mean, we did talk about the tech sell-off last time, and in some rotation in there. Now we've seen it kind of bounce back a little bit, but I mean, for instance, Microsoft beat earnings, right, and then they sold off pretty heavily. What are your thoughts on kind of that sell-off? Is that something that we see a continuance, or you think that's a one and done?
Well, expectations were very high.
Yeah.
Microsoft missed a little bit on cloud revenue. Google outperformed on that metric. But I think as we're looking forward here, a big question I have and others is all this CapEx and R&D. So it's increased for the hyperscalers, so Amazon, Meta, Microsoft, and Google. Those four have increased their CapEx and R&D since the beginning of the year by $65 billion.
Wow.
Yet analyst estimates have only increased profit expectations by $58 billion. So you got a $7 billion shortfall. So once you're in that high growth stage at some point, then there'll be a crossover. And we're waiting to see if those companies actually do fulfill on that. There's a question now, when will the returns come from all this CapEx and R&D? That was actually 2024 and 2025.
Yeah.
There's the increase in R&D, and then looking at the sales, 2025 and 2026.
Well, Kevin, thanks for the update on earnings. All that makes sense. But let's pivot into what's happened this week. The Fed came out, and I think most everybody knew the Fed would probably remain pretty, in the stance on interest rates. They weren't going to do anything, and they didn't. But it's kind of looking going forward. And one of the things I want to remind people is, everybody keeps talking about a cut. Now, remember, the beginning of the year, there's predictions of 6 rate cuts. Well, that didn't happen, right? So we got to be careful with the forecasting of how many rate cuts are out there. But once the Fed does change that direction, it's typically not a one and done. I mean, that direction lasts for a while. I wanted to get your thoughts on, what you heard from the Fed, and then where do you see interest rates going for the remainder of the year?
Yeah, you're right. Historically, they have been aggressive once they start a rate cutting cycle. The expectation is they will begin cutting in September. That's basically, I think, has a 90% plus probability of happening. And I would agree with that. The question is, how far do they go with it? Is it the beginning of a more aggressive rate cutting cycle? I would tend to think probably not, unless we shift to a hard landing scenario.
Okay. Yeah. And
the reasoning for that, and we've talked about it before, the high fiscal spending is likely to continue, irrespective of who wins the election in November. Ongoing trade issues, tariffs, we're moving away from globalization. That implies a higher level of inflation as well, less efficiency. So I think, I hate to say it, but this time will be different.
Yeah, I know.
I think they will cut from 5.5, but they're not going to go all the way back down to 2. It's not going to be as aggressive as the historical rate cuts have been.
I do agree with you, and I think that what the Fed is trying to do is create this glide path, just this whole landing. They're trying to, make sure they can balance out, not have a hard landing like we've talked about. And so I think that to your point, but if they do cut, what do you think the catalyst, what is going to be the reason and why they give us in terms of a cut in September?
I think they're hyper-focused on the labor market right now.
Okay.
And push comes to shove, irrespective of what commodity prices are doing, which would be the most likely factor to push inflation higher, they will choose to support the labor market and growth.
And are you seeing any stress in the labor market now?
Not really stress at this point. I think it's very balanced. It has weakened, certainly, over the past few months. Now, the non-farm payrolls will come out on Friday. I think the estimate is 150,000.
Mm-hmm.
I wouldn't be surprised to see it a little bit weaker than that. And Hurricane Beryl could be part of that. And then when you look at jobs created, then hours worked, and wages could surprise to the upside just because you had fewer lower income people working during Beryl.
Yeah.
And so little dynamics. I mean, you should never trade based on a non-farm payroll and say this is the beginning of a trend.
Well, do you think any of this would be, sentiment driven? Like, for instance, the consumer. I mean, consumer is a huge part of what the Fed wants to look at. For those that make under $75,000 a year, I mean, the sentiment's been declining for 3 months, but we just saw a downtick in those making over $100,000. We're seeing a downtick in sentiment. So, I mean, you think the Fed might be factoring some of that into play?
Yeah.
Okay.
And for the majority of households, and I think small businesses, borrowing rates are too high.
Yes.
And we saw from McDonald's this week, the average meal is 30% higher than it was in 2019.
Oh,
so there's real stress out there. You don't see it in the S&P 500, the top 100 companies, but the smallest companies and the lower income households really are feeling it right now. And
I went through a drive-through, and I'm going to tell you, I thought I went out for dinner. It was just for two. I'm like, you got to be kidding me. So I mean, 30 something, $35. It was ridiculous. I mean, when has that ever happened in fast food? But so I hear you on that. Well, I do want to close because, I mean, since our last lowdown in terms of the political arena, a lot has happened, as we all know. And, the term Trumponomics is certainly out there, but I wanted to get maybe, because we're about to get into that stretch into the election here, and I wanted to get your thoughts on what are you hearing, and then in particular, if we're favoring a certain, group, where do you maybe start to position your portfolios?
Yeah, so I guess Trump has, I think, about a 70% chance of winning presidency.
Yeah.
Last I saw, anything can happen, as we've seen over the last
few
weeks.
Yes, it can. Yeah.
The Senate is most assuredly going red.
Okay.
It's a toss-up as to what will happen in the House. If that happens, if we have gridlock, so in other words, if the Democrats win the House, then you're going to see Trump focus more on immigration, regulatory actions, which is decreasing regulations, and tariffs.
Okay.
He would offset those tariffs with increased oil production, and that would be his number one inflation fighting tool. And if he does end the war in Ukraine, then Russian nat gas would come out onto the market as well. A red wave would be continuing the TCJA cuts for estate and income tax, business expenses. So that would increase the deficit more than gridlock. So the read-through kind of on that then would be on the bond market, a steeper yield curve.
Okay.
Where we see the longer end rates move up. And that's what the whole gold move is about.
Yeah.
The fiscal spending continues. Nobody's reducing the deficit. And the
35 trillion.
Yeah. And the cost of owning 10-year treasuries is going up relative to the 2-year. With that scenario, that would favor value stocks.
Okay.
Over growth stocks. Now, the compounders and the hyperscalers can still do very
well.
Sure. But taking that part out of the equation, value and financials would be certainly at the top of the list. Those especially focus on higher grade finance, larger customers, larger balances, institutional trading, and so forth, versus the likes of a Capital One, which is more in the
lower income.
Lower end.
Yeah.
And then with that, then commodities probably as well. So a different allocation.
Okay.
Than we've seen before, where it's just big tech growth.
Yep. So the concentration now moving to a little bit more wider breadth in the markets is what we're going to see.
Right.
So more participation. Well, that's good. I mean, staying diversified, again, getting back into the value plays, I think certainly makes sense. You're kind of pointed to maybe kind of not too far out on the bond market on the yield curve as far as positioning fixed income, maybe in the kind of that intermediate range. Wouldn't be a bad place to be positioning. So, Kevin, look, all great stuff, and appreciate your time, and we'll see you here next month with a lot to talk about.
It always is.
All right. Thank you.